Hey crypto warriors, Boney here, and if you thought yesterday's Fed decision was just another boring monetary policy meeting, you're about to discover why you're completely wrong. While Jerome Powell was speaking yesterday, over $450 million got liquidated from crypto markets in a matter of hours. Bitcoin dropped below 116,000, Ethereum crashed through 3,700, and the entire crypto ecosystem just got a reality check about who really controls the money flow in this game. Today's episode is airing a little late than usual as I'm out of the country. All normal schedule will be back by Monday. But here's what the mainstream media isn't telling you, and what most traders completely missed while they were panicking about their positions. The Fed's decision to hold rates at 4.25 to 4.5% wasn't just a pause, it was a strategic setup for what could be the most explosive crypto rally we've seen since 2021, or potentially the most devastating crash since 2022. And today, I'm going to break down exactly 3 scenarios that every serious crypto trader needs to understand, complete with precise technical trigger points that could determine whether you're buying a Lambo or eating ramen for the next 2 years. If you're new to the channel, I'm Boney, and I've been navigating these crypto waters since Bitcoin was trading in the hundreds, not hundreds of thousands. I've seen every Fed decision, every market cycle, and every time the so-called experts said crypto was dead. Spoiler alert, they were wrong every single time. But this time is different, and I'll explain exactly why in the next 18 minutes. Before we dive into these game-changing scenarios, smash that like button if you want more real-time crypto analysis, hit subscribe and ring the notification bell because the next few months are going to be absolutely wild, and you don't want to miss a single update. Trust me, your portfolio will thank you later. Let's start with what actually happened yesterday, because if you only read the headlines, you miss the most important details that are about to reshape the entire crypto landscape. The Federal Reserve kept interest rates unchanged at 4.25 to 4.5%, marking the 5th consecutive meeting without a rate change. But here's where it gets interesting, and this is crucial for understanding our trading scenarios. 2 Federal Reserve governors, Michelle Bowman and Christopher Waller, actually voted against this decision. They wanted to cut rates by 25 basis points. This was the first double descent we've seen since 1993, and it signals something massive brewing beneath the surface. When Fed governors start breaking ranks, it usually means the economic data is telling a different story than the official narrative. Now here's what most people don't understand about crypto's relationship with Fed policy. Bitcoin and Ethereum aren't just digital assets anymore, they're macro assets that respond to liquidity flows just like stocks and bonds. When the Fed keeps rates high, it makes traditional fixed income investments more attractive, pulling capital away from risk assets like crypto. But when they cut rates, that $25.4 trillion bond market starts looking a lot less appealing, and guess where that money goes? According to a comprehensive white paper I analyzed from Cognac Research, there's a direct correlation between Fed rate cuts and Bitcoin price movements. For every 1% the Fed cuts rates, Bitcoin historically sees a 13 to 21% price increase. But under certain market conditions, this could amplify to as much as 30% per rate cut. Think about that for a second. If the Fed cuts rates by just 0.5% over the next 6 months, we could be looking at Bitcoin hitting $140,000 or higher. But that's just one scenario, and the crypto markets are never that simple. The CME FedWatch tool is currently showing an 88% probability of at least 2 rate cuts by the end of 2025, with a 60% chance of the first cut happening in September. These probabilities are constantly shifting based on economic data, and that's exactly what creates the trading opportunities we're going to explore. And before we dive into our 3 scenarios, we need to understand exactly where we stand right now from a technical perspective, because the charts are telling us a very specific story that most traders are completely ignoring. Bitcoin is currently trading around 116,700, and it's showing some concerning technical signals. We're seeing bearish price crossovers with the 20-day adaptive moving average. And more importantly, Bitcoin has fallen back under both the daily and weekly pivot points. For those of you who don't trade technical analysis, pivot points are like gravitational centers for price action. When an asset falls below these levels, it usually signals more downside pressure. Ethereum is in an even more precarious position at $3,736, down nearly 2% from yesterday's close. We're seeing the same bearish signals. Plus, Ethereum is showing bearish engulfing candlestick patterns, which often precede significant moves lower. The ETH to BTC ratio is also weakening, which tells us that even if Bitcoin recovers, Ethereum might lag behind. But here's what's really interesting, and this is where the opportunity lies. Both Bitcoin and Ethereum are testing critical support levels that have held multiple times over the past few months. Bitcoin's key support sits at $105,450, which analyst Ali Martinez has identified as the line in the sand for the bulls. If this level holds, we could see a rapid reversal toward 125,000 and potentially 141,700. For Ethereum, the critical support zone is around $3,600. A break below this level could trigger a cascade down to $3,400, but a bounce from here could target the $4,000 psychological resistance level that's been capping rallies for weeks. Now here's where most traders make their biggest mistake. They look at these technical levels in isolation, without considering the macro environment we just discussed. The Fed's monetary policy is the tide that lifts or sinks all boats in the crypto ocean. Technical analysis tells us where the waves might break, but Fed policy determines whether we're dealing with a tsunami or a gentle swell. The liquidation data from yesterday's Fed decision gives us another crucial piece of the puzzle. $450 million in positions got wiped out, with Ethereum leading the carnage at over $100 million in long liquidations. This kind of forced selling often creates the exact bottoms that smart money uses to accumulate positions for the next leg higher. Popular analyst Michael van de Poppe made an excellent point about Fed meetings that every crypto trader needs to understand. He said, and I quote, "The first move after the FOMC is almost always a fake move on Bitcoin and altcoins. It traps everyone, and then it rotates the other way around." This is exactly what we might be seeing right now, and it's why our scenario planning is so critical. Now let's dive into our first scenario, which I'm calling the dovish surprise. This is the scenario where the Federal Reserve delivers an unexpected rate cut, either at the September meeting or potentially even an emergency cut if economic conditions deteriorate rapidly. The probability of this scenario is currently around 12% according to Fed funds futures, but here's why it could be much higher than the market is pricing in. The two dissenting votes we saw yesterday suggest there's growing pressure within the Fed to ease policy. If we see any weakness in upcoming economic data, particularly in employment or consumer spending, that 12% could quickly become 50% or higher. In this scenario, a 25 basis point rate cut would likely send Bitcoin toward our first target of $140,000. This represents about a 19% upside from current levels, but based on the historical correlation data, it could happen much faster than most people expect. When the Fed cuts rates, it's not just about the immediate impact. It's about the signal it sends to global markets that liquidity is about to increase dramatically. Here are the specific technical trigger points for this scenario. For Bitcoin, we want to see a decisive break above $120,000 with significant volume confirmation. This level has acted as resistance multiple times, and a break above it with Fed dovishness would likely trigger algorithmic buying from institutional players. Our stop loss would be set at 112,000, giving us a risk-reward ratio of about 1 to 3.5. For Ethereum, the trigger point is a break above $4,000 with the RSI indicator moving above 60. Ethereum has been lagging Bitcoin recently, but in a dovish Fed scenario, it often plays catch-up aggressively. Our first target would be $4,500, with a stretch target of $5,200 based on the correlation multiplier with Bitcoin's move. The trading strategy for this scenario requires patience and precision. We don't want to chase the initial move higher because, as Michael van de Poppe warned us, the first reaction to Fed decisions is often a fake out. Instead, we wait for the market to digest the news, potentially see a small pullback, and then enter on the confirmed breakout above our trigger levels. Position sizing is crucial here. In a dovish surprise scenario, volatility will be extreme in both directions. I recommend starting with a 2% position size and adding another 1% if the trade moves in our favor and breaks through the first resistance level. Never risk more than you can afford to lose, because even in the best-case scenario, crypto markets can be brutally unpredictable. The institutional flow in this scenario would be massive. We're talking about capital rotation from the $25.4 trillion bond market into risk assets. Bitcoin ETFs, which are already up 20% year to date, would likely see unprecedented inflows. This isn't just retail FOMO, this is institutional money that moves in billion-dollar chunks. But here's the key insight that most traders miss. In a dovish surprise scenario, it's not just about buying Bitcoin and Ethereum. The entire crypto ecosystem benefits, but some assets benefit more than others. DeFi tokens, Layer 1 blockchains, and anything related to yield generation typically outperform in low interest rate environments because they offer higher yields than traditional fixed income. Our second scenario is what I'm calling the hawkish hold, and this is actually the most likely outcome based on current Fed communications and economic data. In this scenario, the Fed not only keeps rates unchanged but adopts a more hawkish tone about future policy, potentially pushing rate cut expectations further into the future. The probability of this scenario is around 60%, making it our base case. Jerome Powell has been consistently messaging that the Fed wants to see more evidence of sustained disinflation before cutting rates. With the economy still growing at 3% annually and unemployment remaining low, there's less urgency to ease policy than the market might be hoping for. In this scenario, Bitcoin and Ethereum would likely enter a prolonged consolidation phase, with Bitcoin trading in a range between $105,000 and $120,000. This might sound boring compared to the explosive moves we've seen in previous cycles, but range trading can actually be incredibly profitable if you know how to play it correctly. The technical trigger points for range trading are different from breakout strategies. For Bitcoin, we're looking to buy near the $105,450 support level and sell near the $119,000 resistance. The key is to use tight stop losses, typically around 2 to 3%, because range trading requires quick exits when the setup doesn't work. For Ethereum, the range would likely be between $3,600 on the downside and $3,950 on the upside. The ETH to BTC ratio becomes crucial in this scenario because Ethereum's relative performance often signals which direction the broader altcoin market is heading. The beauty of range trading in a hawkish hold scenario is that it allows you to compound gains over time while waiting for the next major catalyst. Instead of making one big bet on direction, you're making multiple smaller bets on mean reversion within the established range. Professional traders love these conditions because they're predictable and profitable. Position sizing for range trading should be smaller than breakout trading, typically around 1% per trade. The frequency is higher, but the individual risk is lower. You're essentially becoming a market maker, providing liquidity at key levels and getting paid for that service through the bid-ask spread. The institutional behavior in this scenario would be cautious accumulation. Large players would use any dips toward the bottom of the range to slowly build positions, knowing that eventually the Fed will have to cut rates. This creates a floor under the market that retail traders can piggyback on. Here's a crucial insight for this scenario. Time becomes your friend rather than your enemy. In explosive bull markets, you're racing against time and FOMO. In consolidation phases, you can be patient, wait for the best setups, and avoid the emotional mistakes that destroy most trading accounts. The macro backdrop supporting this scenario includes continued economic growth, stable employment, and gradual progress on inflation. The Fed would essentially be buying time to see how their previous rate hikes continue to work through the economy. For crypto, this means reduced volatility but also reduced upside until the next major catalyst emerges. Our third and final scenario is the one nobody wants to talk about, but every serious trader needs to prepare for. I'm calling it the inflation shock, and it's the scenario where the Fed not only keeps rates unchanged but actually raises them by 25 basis points due to unexpected inflation pressures. The probability of this scenario is only around 3% based on current market pricing, but the impact would be absolutely devastating for crypto markets. We're talking about a potential cascade that could send Bitcoin down to $85,000 to $95,000 and Ethereum below $3,000. This isn't fear-mongering, this is risk management. The catalyst for this scenario would likely be a resurgence in inflation, possibly driven by geopolitical events, supply chain disruptions, or the inflationary impact of President Trump's trade policies. If core inflation starts moving back toward 4% instead of the Fed's 2% target, they would have no choice but to tighten policy further. The technical trigger points for this scenario are breaks below key support levels with significant volume. For Bitcoin, a break below $105,000 would likely trigger algorithmic selling and force more liquidations. Our short entry would be on a confirmed break with a tight stop loss at $112,000. For Ethereum, the breakdown level is $3,400. A break below this level with RSI moving below 30 would signal that the selling pressure is accelerating. The targets in this scenario are 3,400 for Bitcoin's first support and 2,800 for Ethereum. The trading strategy for this scenario is completely different from the first two. We're not looking to buy dips, we're looking to profit from the decline or at minimum hedge our existing positions. This could involve buying put options, using inverse ETFs, or carefully managed short positions. Position sizing becomes even more critical in this scenario because the moves would be violent and unpredictable. We're talking about billion-dollar liquidation cascades that could happen in minutes, not hours. Risk management isn't just important, it's survival. But here's the contrarian insight that could make this scenario incredibly profitable for prepared traders. Extreme oversold conditions create the best buying opportunities for long-term investors. If Bitcoin did drop to 85,000 in an inflation shock scenario, it would likely represent one of the best accumulation opportunities we've seen since the 2022 bear market. The key is having the cash available and the emotional discipline to buy when everyone else is selling. This is where the range trading profits from Scenario 2 become crucial. They provide the dry powder needed to take advantage of Scenario 3 if it unfolds. Now that we've covered all three scenarios, let's talk about the most important part of this entire analysis: how to actually manage your portfolio and risk across these different outcomes. This is where most traders fail, not because they can't identify opportunities, but because they can't manage the risks properly. The first principle is position sizing based on scenario probability. Since Scenario 2, the hawkish hold, has a 60% probability, that should be your base case allocation. This means keeping most of your crypto exposure in range trading strategies with tight risk controls. You're not swinging for the fences, you're playing for consistent singles and doubles. For Scenario 1, the dovish surprise, you want to have some capital allocated to breakout strategies, but not so much that you're devastated if it doesn't happen. I recommend no more than 25% of your crypto allocation positioned for this outcome. The risk-reward is excellent, but the probability is lower. Scenario 3, the inflation shock, requires a different approach entirely. This is about hedging and protection, not profit maximization. Consider allocating 5 to 10% of your portfolio to protective strategies like put options or inverse positions. Think of this as insurance, not investment. The maximum crypto exposure I recommend for any portfolio is 15% of total assets. I know that sounds conservative to crypto natives, but remember, we're trying to build long-term wealth, not gamble on short-term price movements. The other 85% should be in traditional assets that provide stability and income. Cash reserves are absolutely critical in this environment. I recommend keeping at least 25% of your investment capital in cash or cash equivalents. This serves multiple purposes. It provides buying power for opportunities, reduces overall portfolio volatility, and gives you the psychological comfort to take calculated risks with your crypto allocation. Stop-loss discipline is non-negotiable. Every position should have a predetermined exit point that you set before entering the trade. Never risk more than 1% of your total portfolio on any single crypto trade. This might seem overly conservative, but it's what allows professional traders to survive and thrive through multiple market cycles. The monitoring indicators you need to watch go beyond just crypto prices. Fed funds futures tell you how rate cut probabilities are shifting. The DXY dollar index has an inverse correlation with crypto prices. The VIX measures overall market fear and greed. The crypto fear and greed index shows sentiment extremes that often mark turning points. On-chain metrics provide another layer of insight that most retail traders ignore. Whale movements, exchange inflows and outflows, and long-term holder behavior often signal major moves before they show up in price action. These tools are freely available, but most people don't know how to interpret them correctly. As we wrap up this deep dive into the three scenarios that could define crypto markets over the next 6 months, let's talk about what you should actually do in the next 24 hours to position yourself for success regardless of which scenario unfolds. First, If you don't already have a plan for each scenario, pause this video and write one down. Seriously, stop watching and go write it down. Trading without a plan is like driving blindfolded. You might get lucky for a while, but eventually you're going to crash. Your plan should include entry points, exit points, position sizes, and most importantly, what you'll do if you're wrong. Second, check your current positions against the technical levels we discussed. If you're holding Bitcoin above 120,000 or Ethereum above 4,000, you might want to consider taking some profits and waiting for better entry points. If you're holding near the support levels, you're in a good spot to add if we get confirmation of scenario 1. Third, set up alerts for the key levels we identified. You don't need to stare at charts all day, but you do need to know when important technical or fundamental developments occur. Most trading platforms offer free alert services, and there are excellent mobile apps that can notify you of Fed communications or major price movements. Fourth, start following the economic calendar more closely. The next major catalyst will likely be the September Fed meeting, but there are plenty of economic data releases between now and then that could shift the probabilities of our three scenarios. Employment reports, inflation data, and Fed speaker comments all matter more than most crypto news. Finally, and this is crucial, start thinking about crypto as part of a broader investment strategy, not as a get-rich-quick scheme. The traders who survive and thrive through multiple cycles are the ones who treat this like a business, not a casino. That means proper risk management, diversification, and emotional discipline. The crypto market is entering a new phase where macro factors matter more than ever before. The days of buying any random altcoin and expecting 10x returns are largely behind us. The future belongs to traders and investors who understand the intersection of monetary policy, technical analysis, and risk management. If this analysis helped you understand the current market dynamics better, please hit that like button and subscribe for more content like this. I'll be monitoring these scenarios closely and providing updates as new information becomes available. The next few months are going to be absolutely critical for crypto markets, and I want to make sure you're prepared for whatever comes next. Remember, in crypto markets, it's not about being right all the time, it's about managing risk and positioning yourself to benefit from the scenarios that do unfold. Stay disciplined, stay informed, and most importantly, never risk more than you can afford to lose. Until next time, this is Bonnie, and I'll see you in the next video.